In terms of how bad things could potentially get, we gotta talk about the year 1907. This was a time when the stock market crashed 50% after the 1906 San Francisco earthquake, when heavy insurance payouts caused people to withdraw their gold from banks. Of course, that resulted in people panicking, the entire economy collapsed, and fun fact, that actually led to the financial policies that we have put in place today, known as the Federal Reserve. However, shortly after this 50% sell-off, the stock market surged 193% over the next 4 years, and that continued until we hit the Great Depression of 1929. Back then, the issue was that banks were lending out money to people so freely for the purposes of investing, because back then, the stock market just kept going higher. But once the stock market showed the slightest glimpse of topping out, everyone started selling at the same time. They then went to the banks for fear that the banks would go out of business and started to pull their cash out, but the banks didn't have the cash because they had lent it out to other people for the purposes of investing. This led to the stock market dropping 83% over 3 years with a nearly 25% unemployment rate. In fact, the stock market didn't fully recover for almost 20 years when World War II offered enough work for the 17 million Americans who were unemployed.